hummus, hummus.
Good afternoon. You're watching Business World Live. I'm Jes Delos Santos. Let's take a look at how the local bourse closed today, Monday. All right, local shares starting the week on a sour note, slumping the most in Asia. The index ended Monday retreating 1 7/10% to 6,810.34. Its worst output yet since January 29th. As you can see there, a last-minute sell-off, even sending the index further down to the 6,800 level. Videos Jonathan Ravella saying that sentiments remain weak due to a number of reasons. That includes vaccine delays, elevated infections, and rising oil prices over the weekend. Of course, the country logged its highest death toll from COVID-19 since September of last year. That's 239 fatalities with 2,214 new infections, according to government data compiled by Bloomberg. The country averaged 1,713 new cases daily last week. That is a markup from its previous 1,683 average. This puts into question whether or not current lockdowns will be extended or if the president will finally decide tonight to place the entire country under MGCQ as recommended, of course, by members of the Interagency Task Force and Metro Manila mayors. Well, this bit of news unable to lift sentiment here. The local FDA finally granting Sinovac emergency use authorization, making it the first vaccine brand to actually ship to the Philippines. But it's not recommended to be used in healthcare workers. Its efficiency for the group is quite low at just 50.4%, says FDA Director General Eric Domingo. It will instead be used for healthy persons aged 18 to 59, where it has a 65 to 91% efficacy rate based on trials in Indonesia and Turkey. The palace says it will likely be given to soldiers and non-health frontline workers like supermarket employees. Now, the question now is, when will it be arriving? Well, Health Secretary Francisco Duque said the Chinese pharmaceutical has asked for 3 to 5 days to prepare for shipment. The palace had earlier harped on about its target arrival of Sinovac shots tomorrow, February 23. But of course, that's not bound to happen. Speaking of vaccines, the country is hoping to get approval for another $700 million loan from the AIIB and the Asian Infrastructure Investment Bank. That is by next month. This is targeted to help the government procure COVID-19 shots under the Second Health System Enhancement to address and limit COVID-19 in Asia Pacific, which needs $764.17 million. Of that amount, $400 million will be coming from the AIIB, $300 will be coming from AIIB, while the $64 million will be shouldered by the government. But going back to the bourse here, Velas expects the main index to test 6,700 in the near term due to a lack of catalyst, and could even slip further to 6,500. As you can see right now, Ayala and SM Investments pulling down the index today. The two conglomerates combined accounted for close to half of the bellwether index decline. Ayala Corporation, as you can see here, the day's worst performer, slumping by 4 6/10% to 760 pesos a share, while SM Investments plunged 2 9/10% to 1,034. Only 4 of the 30 members capping the day on the upside here, headed by Metro Bank, which rose 1.5% to 50 pesos and 85 centavos a share. All sectors in the red as expected. Financials even losing over 0.7%. That as S&P expects non-performing loans among local banks to climb in the first quarter as loan moratorium and fiscal support end. It says further that NPLs should reach its highest by the second half if the economic recovery is on track. That's expected to increase to 6% in 2021, close to double the 3.6% at the end of 2020. It also says that credit costs will stay elevated at 1.5 to 1.8%. S&P forecasts that profits across the counter will improve slightly this year. As you can see right now, Metrobank, the lone player in the financial space that is in the green. BDO, on the other hand, the worst performer, down 2.3%. BPI likewise also in the negative territory here, slipping by close to 0.5%. All right, picking up from that report with expectations that bad loans will remain elevated in the first part of 2021, how might this impact the property sector? To discuss that, as well as their latest research on the sector, we have Joey Bondoc, Senior Manager for Research at Colliers. Good afternoon, Joey.
Hi, Jes. Good afternoon.
All right, so taking off from that report, we saw NPL sliding unexpectedly at the end of 2020, but S&P now forecasting that it would remain elevated this year for the first part at least. How do you expect this to actually affect our the property market?
Well, S&P's forecast is no longer surprising because we have to note that while there's liquidity in the market and while interest rates remain low, mortgage rates still very competitive, it is the banks that have really been wary of lending more to the public. In fact, lending, for example, down at its lowest since 2006. So that has really, affected the take-up as well in the residential market, with the pre-selling of condominium down since 2013. So that just tells you of how much lending has been in the market and how this has affected the property market as well.
All right. Now, like what you did mention, one indicator is that the pre-selling market, in fact, last year has only sold 31,000 units based on your research. But what's interesting here as well, we have mid-income luxury spaces, condominium units having the lion's share of the entire take-up. What drove that?
Well, you have to note also that Metro Manila condominium market is a supply-driven market. So whatever is launched in the market usually is what is taken up by consumers, by clients. So over the past 2-3 years, we've seen a more pronounced launch of mid-income to luxury condominium units. So, for example, mid-income condos priced from 3.2 to 6 million, they would cover more than 40% of total take-up. In fact, these price segments, mid-income, upscale, and luxury, now cover about 80% of total take-up in the market. And this is much higher than the 70% share that we saw in 2019. And moving forward, we're likely to see this trend with mid-income, upscale, and luxury segments all driving the take-up. And these are condos priced starting at about 3.2 million to 6 million for mid-income. And for luxury and ultra-luxury, this would normally start at 8 million pesos per unit.
So at least for the near term, we expect this to be the trend.
Yes, Jes, that is correct. And even beyond the pandemic, as we have been seeing in the market, what developers have been doing is they've been extending payment terms. They've been offering attractive payment terms, down payment terms to a lot of potential buyers. And that has sustained the pre-selling residential market for 2020. But unfortunately, that wasn't enough. And we saw pre-selling take up at its lowest since 2030. But we are likely to see that slightly recovering in 2021.
Okay, at least you see a bit of a recovery, at least when it comes to take up for pre-selling units here. But also of interest here would have to be the locations. This is also a matter of supply here. I mean, higher level of interest here for Mandaluyong and Alabang, Las Piñas. or is this really a sign of new emerging markets?
Well, that is correct, Jess. But we have to note also that in our survey, we excluded major business districts such as Makati, Ortigas, Fort Bonifacio amongst the choices. But over the past few years, it is in these locations where we have seen a significant amount of launches. Okay, talking about Mandaluyong, for example, Makati, Fringe, even Kamanava area. These Fringe locations have really driven the supply in the market. And as I mentioned, Metro Manila market, condominium market is a supply-driven demand. And since most of the supply was coming from those locations, it is also those fringe areas that accounted for bulk of take-up. We'll also have to note that land values in major business districts such as Makati, Fort Bonifacio, Ortigas, even the Bay Area have risen significantly over the past few years, especially starting 2017. And it's now becoming more difficult for developers to offer affordable or mid-income projects in those areas. That's why most of the mid-income launches are now coming from the fringe locations, and much of that demand also has been coming from those peripheral areas outside of our major business districts.
All right, from the residential space, let's divert the discussion here to the office market. Metro Manila office vacancy doubled last year. Same with flexible workspaces. How much of a reprieve should landlords be expecting once the president finally greenlights a possible shift to modified general community quarantine?
Well, that should provide a positive signal to business activities all over Metro Manila. So we now expect more businesses opening, more employees going back to traditional offices. But you have to note, Jess, that not all employees or companies, for example, are allowing their workers to go back to traditional offices. Most of them, or a lot of them, are still asking their employees to work from home. So while we still see some businesses opening or reopening, especially with the government's relaxation of lockdown restrictions, not all are likely to absorb more space moving forward. We have to note that during tighter forms of lockdown, some of these companies, the smaller ones especially, have closed shop and had to return their office spaces to the market. So it can have a positive impact on office space absorption, but it won't be substantial this year. In fact, as we always say, for 2021, office vacancy is likely to reach double digits. It is likely to increase further from 9.1% in 2020. As a result, lease rates will bottom out starting 2021 before recovering by 2022.
All right. How about for hotels this time around? I mean, should there be a shift to MGCQ? What would be the outlook here for hotels? What's interesting as well, according to your report, is that there might actually be a new trend that hotels should be riding on. Tell us more about that.
Well, as a result of the poll that we conducted during our webinar, a lot of people are still looking at the flexible co-working spaces. That's why about 70% of our respondents said that if these vacant rooms or spaces within hotels are offered as flexible workspaces, they are likely to lease out these facilities as co-working facilities or co-working spaces. And that should help prop up the demand for hotels for these leisure establishments across Metro Manila. Of course, as you know, rivals are down 80%. Even expenditures are down by 80%. Filipinos are skimping on travel and tourism and hotel spending. So this is one reconversion or repurposing of assets, so to speak. In speaking about hotels, the conversion into flexible workspaces that should help hotel operators achieve a higher occupancy while Filipinos are not doing staycations, or while foreign travelers are not coming to the Philippines.
And I believe a lot of workers would indeed be interested to actually work in an actual hotel. That, of course, would mean additional revenue stream here for hotels. Thank you very much for your time this afternoon. Senior Manager for Research over at Colliers, Joey Bondoc.
Thank you, Jess.
Thank you, Joey. Here are other headlines we're keeping our eyes on. Another day, another round of pork holiday in today's wet markets. Some vendors opted not to sell pork in protest of the government's price cap. Farm gate prices have now reached 200 to 205 pesos. This means retailers must sell pork at 290 to 310 pesos, which is above the price ceiling set. The Agriculture Department, meanwhile, faced senators in today's hearing. Lawmakers questioned the move to impose lower tariffs on imported pork, saying it could kill the local industry. Agriculture Committee Chairperson Cynthia Villar said the DA should instead push higher tariffs and use the funds to help the local hog industry bounce back from effects of the African swine flu. Now, the Transportation Department is expecting to award at least 65 railway contracts by 2022. That's more than double the current number. Transportation Secretary Artu Gade said DOTR railway officials met with consultants and contractors last week to discuss the processing of their payment claims. The government is expected to have built up a railway project pipeline of 1.7 trillion pesos by 2022. A fifth of government's 8 trillion peso build programs allocated to railways, while the bulk, or 40%, is on other transportation infrastructure. And those are the biggest news this trading day, February 22, 2021. Catch Business World Live again tomorrow at 9:30 a.m. for the market open and 3:15 p.m. for the market close. I'm Jes Delos Santos. We are One News.